Web3 is revolutionizing the real estate industry. Digital real estate platform Roofstock announced last Friday it sold a rental property in Alabama through an NFT enabled by its Web3 subsidiary Roofstock Onchain. Joining us now to discuss is Roofstock head of Web3 initiatives, Sanjay Raghavan. Sanjay, so this is the second sale of a rental property via NFTs enabled by Roofstock Onchain. Tell us a bit about it and how the transaction was settled.
Yeah, no, thanks for having me. As you pointed out, this is the second sale. Matter of factly, we were at Ideas when the first sale happened, Ideas by CoinDesk, and we made our big announcement there as well for the first one. So this is sort of sweet that the second sale is happening, and we're talking about it on CoinDesk TV as well. The buyer was a Web2 buyer, and what intrigued him about this particular asset was that he was able to secure really flexible DeFi lending terms, and it was lower coupon and also more flexible. It was asset-based lending as opposed to personal credit underwriting. And so even though he comes from traditional Web2 and had actually never owned a self-custody wallet, went through the process of learning how to do that, get USDC to purchase for the down payment. And essentially the purchase process itself was very straightforward. He showed up with his down payment on the Teller platform and requested a loan on the asset, which was all done in minutes, and the smart contract from Teller was able to go into our native marketplace and purchase the asset.
Just curious, did the buyer seek financing for the NFT property purchased through USDC? Because I understand your platform has a DeFi lending marketplace built on the Tether protocol. So maybe you could walk us through that process as well.
Yeah, so we have a partnership with Teller Finance, and Teller is a peer-to-peer DeFi lending marketplace. They have a product called USDC.homes, where a buyer that wanted to purchase a property could go and look at our collection, select a specific property that they were interested in, and then basically enter the terms of the loan they were requesting on the Teller platform, USDC.homes. And then a lender on the Teller side can look at loan requests, and if they want to fund one of those, they can approve it. Once it's approved, the Teller smart contract goes and completes the purchase. So pretty straightforward. In this case, the borrower is able to get an interest-only loan at 7% for 2 years without having to go through, providing their pay stubs and bank statements and tax returns and all that. So this was, since it's a rental property, it was a commercial loan, and so Teller was able to do it, fairly instantaneously.
I do want to ask about that, actually, because when someone purchases the NFT, what happens when it gets registered? How does it get registered with the county? In other words, the actual transaction part, and when is it recorded? Because that's a significant part, of course, in real estate, and who pays the transfer taxes and all that stuff.
It's a really great question. So when the real estate asset is purchased from the MLS, right? That's a traditional closing process. And then the property itself gets titled into a single-purpose Wyoming limited liability company. So everything thus far is a traditional real estate process. But once it's been titled in our single-purpose LLC, we can create an NFT that's associated with the sole ownership of that LLC. And so when that NFT trades on a marketplace, really what's happening is that the seller is selling their sole ownership of the LLC to the buyer. And so we're able to get that done instantaneously. There's no conveyance of title from the seller to buyer because the title for the property stays within the LLC. It's the LLC itself that's being transferred.
Okay, so you're able to kind of get around the transfer taxes and things like that, and potentially.
I wouldn't say get around. I would say, people have been buying properties with LLCs even in the traditional world, and we're just using the existing laws and complying with them.
Right. So what happens, though, when they get the mortgage? If this were to be a residential, primary residence situation, so presumably they wouldn't be able to do the LLC format because they would have to have it in their name. But, when you do nonetheless when you borrow in the lending markets, there are some tax advantages to it, right? So, for instance, if you're borrowing a property against a property where it's the primary residence, you get up to 10,000, whatever. Maybe that'll change with SALT, maybe potentially being repealed, but you get that. You get a bit of a tax deduction, and also for corporations, they also get to do some write-offs here. So how are they able to do that if it's a LLC transaction? And how is the mortgage recorded? The loan against it? Is it a loan against the LLC? It's not against the property itself. What rights do the lenders have to foreclose on that property?
Yeah, lots of interesting questions. I'll try to tackle them one by one. So first of all, you're correct that this cannot be done for residential primary occupancy type properties because those would come under consumer lending laws, and we don't have the infrastructure in DeFi to support that right now. So these are done as commercial loans right now because the LLC is a single purpose LLC. It has a rental property and it's in the business of tenanting that property and making rental returns. So from that perspective, right now we're only able to accommodate rental properties in this model for the DeFi lending options. But once the loan comes into the LLC, people will have to talk to their tax professional specifically to see what kind of essentially whether the interest can be deducted as an expense or not. It's a commercial loan, so whatever under applicable laws, people can do whatever is appropriate that they were able to do in the traditional world as well. There's nothing different between owning a property through an LLC in the traditional world and owning it in the Web3 world. Essentially, the only difference here is that there's an NFT that's associated with the ownership of that LLC. But otherwise, it's an identical form of ownership, right? Now, on top of that, the reason why people are moving towards this model is because in TradFi, as you pointed out, getting a loan through an LLC, it's a very cumbersome process, and you can't, obviously do that through Fannie Mae. You're possibly looking at, unless you have, long-term relationships with community banks or local lenders, you're looking at non-bank financing, which is typically private money, hard money at 10 to 12% rates, personal guarantees, and so on. And so we're really removing a lot of that inconvenience in this model because it's asset-based lending, but at a rate that's, pretty much almost comparable to Fannie Mae rates. And that's really the advantage here.
But there's no ability to foreclose, or in other words,
say So even though there's not the traditional form of mortgage recordation, essentially what's happening is there's a pledge of equity from the buyer of the NFT to the lender, and the lien is getting perfected through the NFT being held in the lender's vault. We're specifically opting into Article 8 of the UCC for that purpose, and the control and possession of the NFT gives the lender the right to foreclose on the asset.
Okay.
And instead of settling with
I'm sorry, and who would then service this particular loan, or is it done through, and then usually the servicer, in many cases, the servicer would be the one that would actually, is there a designated servicer on this, or what happens here?
No, so it's a DeFi protocol, so the smart contract expects payment every month, and as long as the payment is made, everything is fine. If there is an event of default, then the NFT would get taken out of the smart contract to a lender-designated vault from where, essentially the collateral liquidation agent can play that role contractually with the lender to list the property on an NFT marketplace, complete the sale, and then recoup any outstanding interest and principal, and then whatever is remaining goes back to the original NFT holder if that indeed happens.
And Sanjay, I understand you have this LLC, intermediaries and whatnot, but is the hope to one day settle it on chain, and we'd have a world where you could settle real estate on a blockchain directly and have more of a peer-to-peer transaction?
That would be amazing when that happens. Unfortunately, I think that's going to take some time because, one, we probably need legislative action to essentially have the title itself recorded on the blockchain. I mean, in an ideal world, if that were to happen, you can look at all liens and encumbrances on the blockchain immutably, and that will open up capital markets, specifically in the areas of mortgage-backed securities and ABSs and all the kind of esoteric structures we've built in the TradFi space would all easily flow into the DeFi space if that were possible today. It is still our hope that that happens one day, because that's the right way to do stuff. It's faster, cheaper, more transparent, and all that. However, I think that will take legislative action at the federal level, and then states and counties will have to opt in. So there's a process for that, unfortunately, and it'll take some time.